clear as mud. Every time you think you understand it, it changes. And a lot of the confusion you all probably have with this is that there's several different programs with flood insurance. You have what's called a pre-firm home, a post-firm home, and then you have a policy that's called a preferred risk policy. So there's different rules for all of these, and that's probably why you get confused and you say, well, I thought this applied and I thought that applied. And it makes a difference which program you're talking about. Pre-firm is a home that was built before 1974. And typically, you don't need an elevation certificate to write a home in something that was built in 1974. It's called pre-firm, and the reason it's called pre-firm is because most of the cities in this area entered the flood insurance program in 1974. Every now and then you'll see someone, maybe in Pocosin or Newport News, that entered it in 1978. But there's a date that every city entered the flood insurance program, and that's called their firm date. And the flood insurance program hasn't always been around. It was developed for mortgage companies back in the 60s. Back in the day, there was no flood insurance program. You had a homeowner policy, and flood insurance was excluded. And mortgage brokers would say, well, you know what, I just can't afford to do loans on properties that flood and then we lose our mortgage. So the flood insurance program was developed for mortgage companies so that they could have flood insurance. And the only entity, I guess, that can demand a flood insurance to be effective immediately is a mortgage company. When you go to closing, coverage can be effective, but that's the only time. Otherwise, there's a 30-day waiting period to get a policy. So the mortgage people have a lot of control, you just don't realize it. But anyhow, you have the pre-firm rate, which is before 1974. You have the post-firm rate, which is after 1974. And you need an elevation certificate for those programs. So that might clear up some confusion why you need elevation certificates and why you don't. There's also something called a preferred risk program. And the preferred risk program is when you're not in the flood zone. The government doesn't require you to carry flood insurance, and mortgage companies don't require it, but you carry it because you want to. You voluntarily carry flood insurance. And that's what we call an X zone. Back in the day, it used to be called the B or the C zone, but now it's called X zone. Premiums under that program are relatively inexpensive, in the $400 range, and you get the maximum coverage of $250,000 on the house and $100,000 on contents coverage. To further get you confused, there's another program called the Preferred Risk Extension, and that happens when a zone has changed. And I know you all are worried about the zones changing, and I'll tell you more about that later. But so keep in mind, there's four different programs for flood insurance, and they all have different rules. And if you can keep that in mind, I've given you a handout which I'm not going to go over it all over a few things, but I just want you to keep this handy because this is the latest thing that's going on in the flood insurance program. And you may have a client to ask you a question and you can use it as a ready reference. But the flood insurance program changes constantly. And everyone thinks insurance companies make money, and the flood insurance program was set up by the federal government, but it's $25 billion in debt right now. And it all started with Katrina. Well, it's not doing so great before Katrina. But Hurricane Katrina didn't help anything. That started it to where the debt was really adding up. Then you had Hurricane Isabel that we had here. You had Irene, and then of course Sandy really topped it off. And there's no way that they could ever repay the government back. They're hoping just to pay back the interest. So that's why they're trying to make their rates more in line with this remapping. It's an attempt to properly rate everybody. And some rates may be lower. Because a lot of this happens to do with developing. If you have farmland and all of a sudden you develop it, well, you've changed the land. A lot of times you put in retention ponds, and the water's going to flow into the retention ponds. Well, those rates may be lower than what it once was. So that's why they're doing remapping right now, is to bring the rates in line with where it should be. They have better equipment now. They have GPS models and just better equipment to figure what's going to flood and what's not going to flood. Technology is a whole lot neater. Now, back in 2009, they remapped Norfolk, and we saw a ton of what's going to happen when they do the remapping. I know Virginia Beach is being remapped. Should happen in July. And here's what happened in 2009, but it's going to change. So back in 2009, and we're a large Norfolk agency, so we saw a lot of homes, say in Larchmont again, there's a couple that's been there for 50 years. They were never in a flood zone. And all of a sudden, they get a letter saying, from the mortgage company, saying, you're in flood zone AE now, which AE is a high-risk zone. You're required to carry flood insurance. And if that policy was properly rated, if they had an elevation certificate, it was built after 1974, their premium could be $2,000 a year. So they're like, we've been in this house for 50 years, it's never flooded, and now you're telling me I've got to pay $2,000 for flood insurance. I can't afford it. So Congress enacted a law, and they developed a program called the Preferred Risk Extension Policy. This was the other policy I was telling you about. So what happens if you have been remapped in the last, since 2008, you're eligible for this Preferred Risk Extension Policy. Rates under there, or just like the Preferred Risk Policy, is usually in the $400 range. And what Congress wanted to happen was, they said, well, you know, we just told you you need flood insurance. It's a surprise. You're not ready to pay $2,000 a year like the premium should be rated. So we're going to let you be under this Preferred Risk Extension Policy for 2 years. Get used to the fact that you have flood insurance and be ready to pay the true premium that you should be. Well, after 2 years, everyone under that program was supposed to come up with an elevation certificate. And when you have an elevation certificate, that's the true rate that the actuaries figure. They take the base flood elevation of the land, which is, in this area, it's usually 7.6 feet, sometimes it's 8.5. If your house is below that area, it's one rate. If it's above it, it's a better rate. So what happened is they said, well, you'll get this elevation certificate when you've been under the program for 2 years. Well, then Congress decided, nah, we can't. Honestly, they couldn't keep up with it. They couldn't figure out how they were going to catch everybody when they renewed, make them get an elevation certificate, and re-rate it. They just couldn't handle all those changes. So they never did it. So people who in 2009 in Norfolk thought they were going to be paying $2,000 2 years later, that's never happened. And they postponed that new rule indefinitely. So what's going to happen with Virginia Beach's remap? It will be a similar situation. I know a lot of you are thinking, oh my gosh, this is going to be terrible, it's going to be expensive. But not necessarily, because if they go under the Preferred Risk Extension Policy, which they should, premium's probably going to be in the $400 or $500 range. And it should stay that way. So that should help you with your sales and your mortgages. That's another thing Congress said is we don't want to stall the real estate market. We don't want to make it worse. We don't want to stall the mortgage department. And it's kind of crazy because they put somebody under the flood program when they should be actually paying a premium of $2,000. And they're only paying $400. And then they have a claim and they're going to pay them $250,000. You can see how much money they're going to lose. You know, it's like you're not paying the true rate. But that's kind of what's happening with the remapping that you'll see. And I don't think it's going to be as bad as what you all think. And back in 2009, it was bad. But since they put it off indefinitely where they need an elevation certificate, that's helped the process. So I don't think that, I know you all are thinking that's going to be terrible, but I don't think it's going to be as bad as you think it is. I hope that makes you feel a little better. Now there's another thing that's happened recently. This happened in October, this new act that came about, the Bigger Waters Flood Insurance Act. And I've left this with you just as a reference and a guide. I'll go over just a few things with it that might help make you explain it, and it kind of ties into the remapping. But everyone, I don't know that everyone understands the definition of flood insurance. If your house floods by itself, that's not really flood. For a flood claim to be a claim, 2 or more acres of normally dry land and 2 or more properties need to flood. So if you just have a flood at your house, that's not really a true flood. It needs to be a certain parameter for that. On page 1, you'll see where it talks about mud flow, and it's the overflow of inland and tidal waters. Flood is actually when the water saturates the ground and it rises from the ground up. It's not because rainwater came in. That's covered under a homeowner policy. The most coverage you can get under the flood insurance program is $250,000 on the house and $100,000 on the personal property. And I know for the mortgage brokers, you don't require coverage on the personal property. When I quote flood policies, especially if the premium is high, I give my clients an option of, here's the quote with $250,000 building only, and here's the quote if you want contents coverage. And most of them will take the contents, but it's nice to give them an option, because I know it helps their mortgage payment. Right before Katrina, there was talk that was going to go to 500,000. And they said, wait a minute, we're not making money as it is now. There's no way we can go up. So I don't think you'll ever see it go above that 250,000. On the next page gives you some of the flood zones that you commonly see. Now, keep in mind, all these flood zones are for all across the country. The most common zones you'll see is in the middle section where it talks about AE and A zones. Back in the day, we used to have A1 through A30. That's kind of gone away. Now it's more AE is what you'll probably see more of. And AE means it's a high-risk zone. Flood insurance will be required. If you go down further, you'll see Zone B. When you see Zone B, watch out, because it's going to be expensive. Zone B you'll typically see in beach locations, like area we most recently see that's been remapped is Shore Drive, down Jefferson Boulevard and the areas along the bay. And when you see V zone, that's because you have a chance of wave wash coming into the house. V stands for the velocity of the waves. So when you see V zone on an elevation certificate, watch out, it's going to be expensive. V is in Victor. Yeah, B was an old zone. B, C, and X are one and the same. That means you're not in high risk zone. So watch out when you see B. And VE is even worse. And typically you don't see that around here. You'll see it in the Outer Banks quite a bit. And C and X, like I said, they are the zones that are you're not required to carry a flood policy. You can if you want to. And keep this in mind, if you have some clients that you think may be remapped, may be a higher area, and the premiums may be crazy, encourage them to get a flood policy now before the zones change. Because if you voluntarily carry a flood policy without being forced to carry it, and if you're remapped, you're grandfathered for that rate. So keep that in mind. But you have to carry continuous coverage. You can't have a policy 1 year and let it lapse. When the zone changes, that policy has to be enforced. It has to not have a lapse in coverage. So keep that in mind for your clients that you may think may have a problem with this right now.